Hello, my name's Dominic Fonte with Cutler Real Estate. Thanks for tuning in today. It is January 15th, 2021, and we're done with 2020 moving forward. So as the real estate market goes, if you're interested in understanding what has happened and what is going to happen, I'm going to share it with you right now. It's going to be a little long, so bear with me if you're interested. All right, so let's recap a little bit on the past. This is a quick snapshot of what's happened, and then I'll give you the forecast for 2021. So the first slide I want to talk about is annual home price appreciation. If you look, there's a red graph and a green graph. If you look at the dates below it, you're going to be able to see 6 years leading up to the housing crash, what the appreciation looked like compared to how it was the last 6 years to the close to the pandemic. And you can see that over the last 6 years, it's been more between 4 and 6%, whereas up to the crash of '08, you had somewhere between 8 and 12%. So we're seeing pockets of appreciation a little higher in some suburban areas. But then when you look at supply and demand, because one of the things going forward in 2021 is, are we going to have a repeat of '08, which was the big short? It was really a bad experience if you were in the housing or the stock market that year. But if you look at the second graph I want to show, it's months inventory of homes for sale. So that's always tied to supply and demand. If you notice, there's a red chart, a green chart, and then a neutral market, 6 to 7 months, that's gray in the middle. What that represents is in a normal real estate buying or selling market, if you have between 6 and 7 months of supply, and that would be a really healthy market, right? Well, if you look at the graph on the 1999 in the green part, it's real low. It's like 5 months inventory. That means that we're in a seller's market. Now, if you look at as the market peaked out before the big drop in '08, you can see it dropped in '06, then it shot way up in '07, and then a couple little peaks and valleys. What that represents is how many months supply. So then it went to the red, which is the buyer's side. That means that we had obviously more than 7 months supply, and you can see on the one column, 13, 12, 11, 10, we had 12 months supply. Now look over here at the seller's market, more to today. We average roughly less than 3 months supply. That means it takes 3 months to burn off our inventory. So that's why the prices are going up and the supply's down and the buyers are fighting for offers getting accepted. When you look at the situation of what kind of equity do we have in our homes, and are we using our homes as an ATM machine like we did back in '08? So if you look at the amount of equity that was taken out, cashed out of the home between '05 and 2007, right before the crash, it was $824 billion. Now, fast forward to now, there's only 247 billion out. So that means that people are in way better equity positions currently than they were leading up to the debacle. The next graph, if you notice, there's a pie chart. 58.7% of all homes in the U.S. have at least 60% equity. Now that's unbelievable. So that means a lot of the people in the U.S. that own homes have a good stake of real estate value that they can tap if they needed to. So 42.1% of the homes in the U.S. have no mortgage at all, so they're free and clear. Okay, so now where do we go from here? So that's a quick snapshot of the past, but what's ahead in 2021? Well, the president of Homes.com, Dale, mentioned that with the pandemic, it's changed the dynamic, the paradigm shift of home ownership in the sense that the playbook's rewritten because home buyers are making decisions based on not maybe working in the office anymore. So they might be working at home, they may need workspace at home, and in some cases, they can relocate to a different area, and maybe live on the beach and work as long as that's the case. So there's way more flexibility right now. So the home growth of equity. So when you look at the US map, you're going to notice if you look at Ohio, it's $13,000 is the equity gain, the average equity gain. So if you look across the map, you can see, but of course, real estate's always local. So when you look at real estate, whatever area you live in is what you want to look at to try to figure out what your equity gain is. So you could see the majority of the U.S. is in a pretty solid position. Now in 2021, they always make these predictions. This would be like the National Associations of Realtors, Realtor.com, CoreLogic, Freddie Mac, Fannie Mae, the Mortgage Association, Bankers Association. They're projecting that we're going to see probably, in the next year or so between 2 and 6% home price appreciation. Again, it just depends, because there's certain pockets that are about 12%, and then there's pockets that are 2%. So you just have to look at them individually. And if you need assistance, you can have your agent, or I can reach out to you and help you. The unemployment projection. So the Wall Street Journal and the Fed project that it's 6.7 now, but in 21, 22, and 23, they're anticipating a drop to about 5.5, 5. And then in 22, between 4.2 and 4.8, and in 23, 3.7 to 4.4. That's their guesstimations. Now, forbearances, you might hear a little bit about forbearances. So when the downturn happened, when we had the COVID, we had this situation where a lot of people in the hospitality industry and a lot of industries got crushed, and they were having some financial struggles in order to keep their payments, rents, and whatnot up to speed. So there were roughly 2.7 million homeowners, they estimated, that would be maybe needing some assistance. So that means they can delay on their payments or do a workaround or work out with that. But what happened was a lot of people out of the 2.7 million, 1.57 million on the graph, that's 58%, basically are now resuming their payments. They're solid, back on solid ground. Out of that 2.7 million, there's also 24% that within a year of exiting the forbearance may put their home on the market. Now remember, the prior slides I talked about the equity position. So a lot of people have equity in their home. So instead of like leading up to '08 where everything was either a short sale or foreclosure, in this case, they have equity, so they may sell their home. The forbearance basically hurt the credit. If you did, pay your payments on time, it affects your credit. And if you decide that you can't recover, which is unfortunate because a lot of people are hurting, then you would probably sell your home, hopefully put some money in your pocket, and just rent a place until you get back on your feet. And then they're projecting about 18%, 486,000 out of the country that may have what's called a foreclosure. Now, if you look at the distressed properties, the percentage of distressed properties, so the graph really shows 2012 to 20, January 2020, and then of course now we are into 2021. And you see the mountain on the one side says 35%. So that means that 35% of every single sale that has happened in that period of time was either a short sale or foreclosure. And if you remember, that was about a 20 to 30% drop in our real estate values almost overnight. And that was very scary. The whole system shut down. Actually, the movie The Big Short gave a good representation of what we actually went through during that spell. Now in January 2013, moving forward, you notice the mountain is getting smaller, which means, we went all the way down to January 2019 from 35 to 4% damaged asset, which means short sale or foreclosure. Now we're at 1%. So if some of those forbearances turn into foreclosures, there's talk of an avalanche of foreclosures, which could destroy the market again like in '08. But in this case, I predict that won't be the case because we're such a short demand of real estate that it will be absorbed into the marketplace, and that won't hurt the values of your current situation, in my professional opinion. Now, days on market. So how long does it take for the house to go under contract under average circumstances? Now, there's always unique situations where a house could go under contract in 1 day or 100 days. But if you look at the U.S. map, the average days on market is 21 days in the U.S., which is unbelievable. So that means it favors the seller, and that's why the sellers are getting more of a premium right now. Now, when you look at the next one, existing home sales, since January 2014, if you notice, the graph goes up and down, up and down, up and down, and then January 2020 or February, there's a big V, so it dropped way down. Now that's when we found out we have a major problem with COVID. Once we figured out how to deal with that safely and meet the customer where they were at as far as safety goes, then you saw a big mountain again where it shot up on sales because there's such a pent-up demand. Normally April, May, and June is the big buying cycle, kind of like Black Friday and shopping. It got pushed out a little further due to COVID, and a lot of us really didn't know what was going on. The pending home sales since 2014, if you look at the dotted line, that's the healthy level, but you can see currently where the big V was, and then it shot way up past the healthy levels. So that just goes to show we have quite a pent-up demand at this point. Looking at months of inventory homes over the last 2 years, you could see May 2018 all the way up to November 2020. You're going to see 4.2 all the way down to 2.3 in the blue far, as far as November goes. This is the National Association of Realtors tracking it over the last 2 years. So remember I told you early in the beginning of this, we were talking about the gray zone, 5 to 7 months worth of inventory, which is the neutral zone, or where it would be a good balance between buyers and sellers. It's been 2.3 months. So if foreclosures come into the marketplace, we have some room to absorb those without it hurting the standard real estate market like it did in '08. So if you look at the last 12 months of inventory, you're going to notice November is 3.7, then it drops down. Then April, May, and June, you see how it shot back up? Because that's when people paused. Normally April, May, and June's the biggest buying part, like a Black Friday. A lot of people were scared. They didn't know what was going to happen. So everybody paused. You pull back when you're afraid. Then things started picking up and the inventory dropped all the way to 2.3 months. Now we're looking at that in conjunction with, say, a lot of the younger people the millennials replacing the baby boomers with the buying. 50% of the young buyers today are baby boomers. And, they're entry-level buyers, getting in there, stirring up the pot, and there's such a high demand. That's why we're short on real estate. Then you have people that want to downsize, and they're trying to be cautious that they don't want to sell their home too quick, and they want to move into a nice one-floor plan or a condo. So there's a little bit of logistics there. You always need a roadmap, and I'd be more than happy to help you with that if you need some guidance. The next slide is the 30-year fixed rate from Freddie Mac. So if you look in January 7th, 2016, now if you've been around a while, when you hear 3 and 4% interest rates, that's pretty attractive. But if you look at the last few years, the rates now are at 2.65 for a 30-year fixed, below 3%. So you can see the up and down between 3 and 4% over the last 3-4 years. And I got to tell you, from what I remember, I remember when we had 12, 14, 16, 18% interest rates. Anything around 3 is a home run. Now, mortgage projections. So what is going to happen over the next 12 months? So Freddie Mac, Fannie Mae, the Mortgage Broker Association, and the National Association of Realtors project the next few quarters. If you take and crush it all together, it's still hovering around 3%. So we anticipate that the supply is still short. We anticipate the rates are going to hover around 3%, which is really pretty strong purchasing power. And then the other thing that I look at from the economic standpoint is the average back end DTI, which is debt to income ratio. So what that means is when people are buying now versus buying up to '08 when you could breathe into a mirror and get a loan, or they had no look or limited documentation loans, you have to have skin in the game. You got to have good criteria. So now all loans, the average of debt to income ratio is 35%, which means if you have a gross income, right, monthly gross income, and you do times 35%, that's your total indebtedness, which would be car loans, student loans, credit cards, and house payment. So that's a nice solid number. Then when you look at conventional mortgages, it's averaging about 35% debt to income ratio. On FHA or VA, you see a little higher ratio, up to 44%. So in closing, what I'd like to say is I appreciate you tuning in. I hope this wasn't too dry, but I feel that the outlook is bright for 2021 if you're interested in the real estate arena. And like I said, if you want to deal with this, I think it's important to have a good guide, and I'd be more than happy to walk you through it, to be your GPS, because a informed decision maker is a happy decision maker. So if you need anything, you want to reach out to me, you can send me an email at dominic@dominicfonte.com, or you could pick up the phone and give me a call, 330-418-1535, or if you'd like to go to my website, I have 280 some 5-star reviews. If you want a sense of what you would experience working with me, go to www.dominicfonte.com. Thanks for tuning in.